Welcome, future chartered accountants. Let's dive right into a topic that is, without a doubt, a core part of your GST paper: input tax credit.
All right, imagine you're in the exam hall. You get this question. You paid 18 rupees GST on your inputs, and you collected 36 rupees GST on your outputs. So, what's your net tax payable to the government? Well, it's gotta be 36, right? You collected 36, you pay 36. Seems logical.
And that is absolutely wrong. Seriously, this is exactly the kind of simple-looking trap that costs students big marks in the exam. If you thought the answer was 36, it means you're missing the single most powerful and fundamental concept in all of GST.
You know, before we even get into the nitty-gritty of what ITC is, we have to understand the problem it was created to solve. Why does this whole mechanism even exist? It all boils down to this really nasty issue from the old tax days called the cascading effect. Or, to put it simply, tax on tax.
So, back before GST, the whole system was just broken. You had central taxes, you had state taxes, and they didn't talk to each other. You couldn't use the credit from one to pay off the other. And if you bought something from another state, forget about it. You'd often lose the credit completely. What this did was create a cascading effect, where tax was being charged on a price that already included tax. This just made everything more expensive and hurt businesses. GST completely changed the game by creating one seamless, unified credit system.
And this is the solution. Think of input tax credit as the engine that makes the entire GST system run. It's the mechanism that kills that cascading effect and makes sure that tax is only paid on the actual value added at each step of the chain. This is what makes GST a true value-added tax.
Okay, so we know why it's so important. Now let's zoom out and look at the big picture. How does the law actually structure this whole ITC scheme?
All right, here are the main features you need to know. First, its #1 job is to stop taxes from cascading. You get credit on pretty much everything you buy for your business: inputs, input services, and capital goods. You then use that credit to pay off your output tax. Now, a really critical point. You don't have to match every single input to a specific output. The credit just goes into a common pool. IGST is the magic key that allows credit to flow seamlessly between states. But listen up, these last 2 points are where marks are often lost in exams. You get absolutely no ITC on inputs used for exempt supplies. And if you use something for both taxable and exempt supplies, you have to claim credit proportionally. These are huge areas for questions.
Let's be real. If you want to score well in ITSIC, you have to be rock solid on the definitions. ICAI loves to test these, sometimes directly as MCQs, but more often by weaving them into tricky case studies. So let's build that strong foundation right now.
First up, the term input. The definition seems simple, right? It's any goods you use for your business. But what's the most important part of this definition? The phrase, other than capital goods. The law creates a very clear wall between regular inputs and capital goods, and you have to remember that distinction.
Input service is a lot simpler and broader. It's basically any service you use for your business. We're talking about audit fees, transport services, legal advice. Pretty much if it's for the course or furtherance of business, it's an input service.
Okay, now for capital goods. And everyone, please pay close attention here. This is extremely important. There are 2 conditions. 1, it has to be used for business. Okay, that's easy. But the second condition is the one that ICAI loves to play with in exams. Its value must be capitalized in the books of account. So if you buy a huge piece of machinery, but for some accounting reason you decide to expense it instead of capitalizing it, guess what? For GST purposes, it is not a capital good. Always check for that capitalization entry.
So, we're talking about getting credit for input tax. But what is input tax? Well, it's the CGST, SGST, IGST, basically any GST you pay when you buy stuff. It also includes the tax you pay on imports and even tax paid under the reverse charge mechanism. But what does it exclude? This is a classic exam trap. It does not include any tax paid under the composition scheme. Remember, a composition dealer can't give you a tax invoice, which means you can never ever claim ITC on a purchase from them.
And that brings us to the big one, input tax credit. After all that buildup, the definition is beautifully simple. It just means the credit of the input tax we just defined. It's that amount sitting in your electronic credit ledger that you can use to pay your future tax bills.
Awesome. Now that we've got the essentials down, let's build on that with a few more important terms. Getting these right will really help you handle the more complex problems they can throw at you.
We keep saying in the course or furtherance of business, right? So what does the law actually consider business?
Well, the definition is incredibly wide. It's not just your main trade or profession. It includes any side activities, things you do only once, and even activities you do when you're starting up or shutting down your business. The whole idea is to make this definition as all-encompassing as possible.
You'll also see the terms agent and principal. It's a straightforward relationship. The agent is the one doing business, like supplying or receiving goods, on behalf of someone else, and that someone else is the principal. Just keep this in the back of your mind, because it becomes really important for some specific ITC rules later on.
Okay, this one is critical. Exempt supply. Remember we said you don't get ITC on these? Well, the term exempt supply is actually a bucket that holds 3 different things. It includes supplies that have a nil rate of tax, supplies that are specifically made exempt by a government notification, and non-taxable supplies, like alcohol for human consumption. All 3 of these fall under this one umbrella term.
And on the flip side of an exempt supply, you have a taxable supply. Pretty simple. This is any supply of goods or services that GST is charged on. This is the stuff you can claim ITC for, because it's what you use to make your taxable outward supplies.
All right, pop quiz. Let's get practical. Say, buy a forklift to use inside your factory. Is that forklift considered a motor vehicle under the GST law? Now, this might seem like a random detail, but trust me, the answer to this question has a huge impact on whether you can claim ITC on it later on.
And the answer is a big no. Under GST, the definition of motor vehicle specifically excludes special vehicles that are only used inside a factory or some other enclosed premises. So your forklift is not a motor vehicle for GST purposes. This is a super important distinction, and it's a perfect example of how ICAI can test your detailed knowledge.
And just to round things out, let's quickly hit these last few definitions. Inward supply is just when you receive goods or services. The recipient is the person who has to pay for them, the supplier is the one who provides them, and a registered person is anyone registered under GST. But importantly, it excludes people with a unique identity number, like foreign embassies.
Okay, we've covered the why, the how, the what. We've got all the definitions down. But before any of that matters, before you can even dream of claiming 1 rupee of ITC, there is one absolute, fundamental, non-negotiable rule you have to satisfy first.
And here it is. This is the starting line. You must have physically received the goods or services. I don't care if you have the invoice. I don't care if you've already paid the supplier. If those goods haven't actually been delivered to you, the whole conversation about ITC just stops. It can't even begin. This is the absolute first step. Just remember, no receipt, no credit. Period.
So let's just jump right in with a question that feels like it's been pulled straight from an exam paper. A company buys a car for its director, takes the whole team out for lunch, and does a big office renovation. So on which of these can they actually claim input tax credit? Now, it looks simple, right? But the real answer is, it depends. And that it depends is exactly where the examiner loves to catch you out. This isn't just a question, it's a minefield of blocked credits and tricky conditions. By the time we're done here, you'll be able to see right through it. Okay, before we even start talking about what's blocked, we have to figure out what's even potentially eligible to begin with. And that's where apportionment comes in. I want you to think of Section 17 as having 2 essential filters that your total input tax has to pass through before you even glance at that blocked credits list.
The very first filter is Section 17, subsection 1, and the rule here is super simple. GST is a business tax, so if you've used any goods or services for personal reasons, the ITC on that part is immediately out, no discussion. Only the input tax that is 100% for your business gets to move on to the next filter. Makes sense?
Now for filter number 2, which comes from Section 17, subsection 2. From that business portion of your ITC, you can only claim credit on what's used to make taxable outward supplies. And good news, this also includes zero-rated supplies like exports. But if an input is used for making exempt supplies, the ITC for that part is also gone. So here's the mantra: no output tax, no input credit. Simple as that. All right, so your ITC has made it through the 2 apportionment filters. Great. It was used for business, and it was used for making taxable supplies. But hold on, there's one final hurdle, the dreaded Section 17, subsection 5. This is basically a blacklist of expenses where ITC is just blocked, completely disallowed, no questions asked. Well, almost no questions. Let's take a look at the list. First up, motor vehicles. The general rule is ITC is blocked on vehicles used for transporting people if the seating capacity is 13 or less. This also applies to vessels and aircraft. So that director's car from our opening question, blocked. But, and listen up because this is where you score the marks, ITC is allowed if you're in the business of doing one of three specific things. 1, you sell those vehicles, like a car dealer. 2, you transport passengers, like a taxi company. Or 3, you teach people how to drive. You have got to know these 3 exceptions by heart. And this just makes perfect sense. Think of it as a domino effect. If the vehicle itself is ineligible for ITC, then it's no surprise that any related services, like insurance, servicing, and repairs, are also blocked. But on the flip side, if the vehicle is eligible because of one of those 3 exceptions we just talked about, then the ITC on these related services is also allowed. The key takeaway is simple. The eligibility of the service follows the eligibility of the vehicle. Next up is a list I like to call the good times list. We're talking food, drinks, outdoor catering, beauty treatments, health services. ITC is generally blocked on all of it. So that team lunch from our first question, you got it, blocked. But there are 2 very, very narrow exceptions. First, if you're in the same line of business, like a caterer who buys catering services from another vendor. And second, if you were providing these things to your employees because some other law requires you to. That statutory obligation point is absolutely critical. Now, this is a big one, construction. ITC on works contract services or any goods used for constructing an immovable property is blocked. So renovating the office? Blocked. The 2 major exceptions are if you're a works contractor yourself and you're buying services from another contractor, or, and this is super important, if the immovable property you're constructing is actually plant or machinery. But you've got to beware of the ICAI twist. The legal definition of plant and machinery specifically excludes things like pipelines laid outside the factory. That is a classic exam trap right there. Okay, let's do a quick run-through of a few other important blocked credits. You can't claim ITC on tax paid under the composition scheme. That's a definite no. Of course, no ITC for anything you consume personally. And this one is very important for problems. If goods are lost, stolen, destroyed, written off, or even given away as free samples, you have to reverse any ITC you took. And finally, non-resident taxable persons generally can't claim ITC with the small exception of goods they import. Fantastic! We've worked so hard to figure out what credit we can claim. Now let's move to the next critical part. How do we actually use it? This whole process is governed by Section 49, and it lays down a very strict order for setting off your ITC against your output tax liability. I'm telling you, getting this order wrong is one of the easiest ways to lose marks in an exam. So here is the hierarchy, and it is non-negotiable. Rule number 1, the absolute golden rule, is you must use your IGST credit first. You use it to pay off your IGST liability. If there's any IGST credit left over, you can use it to pay CGST and then SGST. Only after your IGST credit balance is completely zero can you even think about touching your CGST or SGST credits. And remember, CGST and SGST are like rival cousins. They can never be used to pay each other's liability. And hey, don't just take my word for it. The law itself, right there in the proviso to Section 49, subsection 5, says it crystal clear. It says that other credits can be used for paying IGST only after the IGST credit has been fully utilized. This one line is a source of so many mistakes in exam papers. IGST must go to zero first, period. Okay, here is a classic crossover point that links GST with income tax. When you buy a capital asset, you have a choice to make about the GST you paid on it. You can either include the GST amount in the cost of the asset and claim depreciation on it under the Income Tax Act, or you can claim it as input tax credit under GST. The crucial thing is, you cannot do both. It is strictly an either-or situation. You have to pick a lane. And here are a few more rapid-fire rules you've got to know. First, the time limit. You can't claim ITC for an invoice after the due date of the September return for the next financial year, or when you file the annual return, whichever happens first. Miss that deadline, and that credit is gone forever. Second, if goods come in installments, you have to wait for the last lot to arrive before you can claim any ITC. Third, for new registrations, you can claim ITC on the stock you had on hand the day before you became liable to register. And finally, if a business is sold or transferred, the new owner can also take over the unutilized ITC. All right, theory's done. Time to make this real. We're now going to apply every single thing we've just learned to solve an exam-style problem for a company called XYZ Limited. This is where we connect all the dots and see how it works in practice. Okay, let's break this down line by line. First, for inputs A, there's an invoice missing for 10,000 rupees of GST. What's the rule? No invoice, no ITC. That's a basic condition under Section 16. So that's out. For inputs B, the goods are coming in lots, and only the first one has arrived. Remember the rule? You can only take credit when the last lot is received. So, no ITC on that yet. Next, capital goods. XYZ Limited already claimed depreciation on the tax component in their income tax return. We just talked about this. It's one or the other. You can't have both. So that ITC is blocked. Finally, input services. They found an old invoice from January. We checked the time limit for the previous financial year, and guess what? It hasn't expired yet. So the $50,000 on that invoice is perfectly claimable. And look at that. After all that, out of a potential 5 lakh rupees of GST paid, XYZ Limited can only claim 50,000 rupees as eligible ITC for the month. This just perfectly shows how critical it is to know every single rule and condition. One small oversight can lead to a massive loss of credit.